Welcome to the Life Unlimited podcast with Larry Heller. You deserve complete financial advice so you can confidently live your life your way, for life. Now, let's get into this week's podcast episode.
Welcome to another Life Unlimited podcast with your host, Larry Heller. Today, we're going to talk about interest rates and investments, understanding the ripple effect on your financial plan. Now, Larry, been in the news, my friend, that the feds just did something.
Yeah, that's
They
right.
did some rate changes. What's up, man?
On September 17th, the Fed cut interest rates, Fed fund rate, by 50 basis points, hoping to stimulate the economy. Hopefully stimulate the economy with a soft landing, which means not sending us into a recession. So, there's a lot of things that make up interest rates and why they fluctuate: inflation, economic growth, unemployment rates. I'm not really going to go into that, but I'm going to kind of go back a little bit in history and kind of talk about what I've seen. And then also, what does that mean to you? How can you manage certain things as far as what's going forward, as far as investments, planning, retirement? So we got a lot of things to talk about. But let's start with a little history kind of lesson here. So for those of you who really remember much higher interest rates, double-digit interest rates, mortgage interest rates at 13, 14, 15%. Matt, you're shaking your head. So
yeah, totally.
So interest rates kind of rose from like the 1950s, and they kind of peaked in 1980. And then from 1980 to 2020, interest rates mostly fell. There were a couple of times where the Fed raised rates, but basically we had 20 years of falling interest rates. So there are really times where the whole generation really never had to live with a rising interest rate environment and had to adjust their investment strategy and their retirement strategy. They just saw rates went down. So what does that mean basically from the investment side? From investment side, if you own a bond and rates go down, the value of your bond goes up. So you were making money on your bonds, but as they matured, they had to be invested at lower rates. So your next yield was going to be lower. So interest rates kept falling. And then we know what happened in the pandemic. Or if you don't really know or remember, what were interest rates in 2020 during the pandemic, Matt?
Dude, they were like close to zero, weren't
exactly.
they?
They were close to zero. So now what do you do when they're close to zero? So then all of a sudden we started to see rising interest rates, and it went up faster than most people predicted. A couple of banks out there made some bad mistakes with that and kind of went out of business, but we went back up. And then finally now, 2024, we had a cut. What is going to happen going forward? What are the next 20 years going to be? Are we going to be more cuts? Possibly, looks that way. But are we going to be in a rising interest rate environment? Who knows what that's going to be? And that's a big challenge for the Fed to be able to manage the interest rates and not put us in a recession. We haven't had really a recession. I'm not going to count the pandemic, but there have been a couple of quarters. So recession is really 2 quarters of negative GDP. So, but basically we haven't had a real recession to 2007, 2009. So can the Fed manage this and properly lower rates? Some people think they're going to lower rates, but then they're going to have to quickly raise rates again to counteract inflation. So it's going to be a real challenge going forward on what to do. But are we in now kind of a new 20-year time frame when rates are going to go back up? We'll see what happens.
I want to digress just for a moment here, because you just opened a can of worms I don't know if you were prepared to open, which is interest rates aren't the only thing that really are tied to inflation, are they?
No, there's other things that are tied to inflation, but so if rates, they're not going to lower rates to stimulate the economy, because if the economy is too stimulated, then inflation can kind of get out of control. So we want to make sure that raising rates would curb inflation. So there's a lot of factors that go into this, but controlling the interest rate helps to control inflation.
All right. Well, let's continue with the whole control thing because when interest rates change, your financial plan can change. What do we do about this?
Right. So let's start with the first thing, borrowing costs, mortgage rates. So I know people think, oh, mortgage rates are so high in this 6 range. But again, as I talked about earlier, there's been plenty of times interest rates are in the double digits. So what do you do now? Do you look as possibly mortgage rates get lower? If you're with a higher rate that you did a few years ago, do you lower your interest rate right now, refinance and lower the interest rates? Will lower rates even spur the housing market even further? The housing market has been driven probably because of need. There's been
Right.
not a great need for home, not a great market, not a what's the word I'm looking for, Matt? Limited supply is what
Yeah.
I'm
There,
looking
there you
for
go. Yeah.
in home. So will interest rates now even tighten that market and set housing even further? So one of the things, if we're planning on buying a house or selling a house, you have certain decisions to make. So these kind of rates have an impact on really where you're going to live and the type of financing you're going to do along those lines. So that's one thing to consider. The other is your retirement planning and some of the adjustments that you should make based upon the expected returns. We've seen people that have come in and they living off their interest back in the 80s because they could. Interest rates were high enough that, yeah, if you can get 15% on a CD, you're making great money, more than what typically you'd make on the stock market. But with rates at zero and inflation, even if they wasn't that much higher than that, you're losing money on keeping money in CDs and CDs. So knowing how to really adjust your retirement, what your withdrawal rates are, what your allocation, we'll go into a lot of those things, but how does that affect your retirement plan? And there are also some people, without going into it, that their pensions, they still have a traditional pension, could be tied into what the current interest rates are at the time that you're making a retirement. So that has an impact as well. And then savings and investments. Obviously the rising and the falling of savings, of interest rates impact savings and CDs. And we've been in an inverted yield curve for a while, starting to flatten out a little bit, where longer rates are higher than shorter rates. So a lot of people didn't want to lock into some higher rates because they were making more money on the shorter rates. But now that shorter rates have kind of starting to come down, as your CDs or treasuries are maturing, you're saying, maybe I should have locked in a little bit more. So, kind of when we do this, we're looking at both short-term, long-term, not trying to guess which way is going to go, but have a mix of both. And we'll talk a little bit about how we talk about bonds in a little bit. And then possibly adjusting your asset allocation along those lines, and kind of get into, cash. And when we look at our reservoir strategy, our retirement strategy, we want to keep 2 to 3 years in liquid assets. And it's great when you were making 5-6% on your liquid assets. But if those rates drop down, maybe you want to keep a little bit less in emergencies than maybe you do when the rates are a little bit higher. Or should we have locked into 3 years? So, and then our rate's going to fall much lower again. There's already been talk the Fed's going to lower rates another 50 basis points down the road. So it's really important to this, because a couple interest rates changes in this rates can affect your portfolio, the amount of money you earn, and how you should set up your portfolio.
Well, let's break down the portfolio specifically. So when it comes to asset classes, so you just talked about the overall components of a financial plan, but let's talk about the asset classes specifically and how interest rates can change what you have to do within each asset class.
Right. So I just started talking about the cash, and how about, cash was great. And even for sitting some money on the sidelines, and you're making 5% on your cash was great. But now that's started to, going to start to go down. You've seen 1-year treasuries, 2-year treasuries decrease. You're going to start to see money markets start to go down. CDs are going to go down. So, but then there's also bonds. So the bonds have been able to get a little bit higher rates of return, with obviously not the risk of the stock market. But now as rates go down, as I talked about, the value of your bonds are going to go up, but as these bonds mature, where are you going to invest them? And what are some of the strategies that are in place and some of the strategies that we use, whether it's laddering bonds over the course of a long period of time, or whether it's a bell, whether it's a bell type shape where you have some in shorter and some in longer. So these strategies in determining what your duration is, what you think the duration is in a falling interest rate environment, so you can tweak kind of your bond portfolio when rates are going down, and then tweak it again when rates are going up. So important to look at your bond allocation, your bond duration, your bond maturity along those lines. And then stock. So as the Fed cuts rates and rates become lower, more people now are, I'll invest in the stock market. So now there's a chance that the stock market will rally even more in this. And we've seen that already with the first 50 basis point cut, that even though we've had a huge run, and a lot of people think maybe we're at the top, but who knows? But now we've gotten even more momentum by this change in interest rates. And then within equities, there's large cap versus small cap. So when rates go down, that usually helps small cap stocks, because those are the companies that need to borrow money to run their business, versus these mega growth, which either can borrow at a lot lower rates or don't need to borrow. So now, will small cap now kind of outperform going forward? Or is there a switch from growth to value stocks? So all those kind of impacts go into the strategies when there's a change in the interest rates. And then real estate, now does that have an impact? Like we talked about before, lowering borrow costs, both on commercial side and on personal side. Will that impact your real estate and that allocation? So those are the main ones, and there's so many different iterations, and depends upon your scenario, your time horizon, your risk tolerance, and what makes sense for you. And that's how kind of we put together our strategies and our portfolios for you. But there's one more asset class that we've been using a lot, and it's also affected by interest rates, and that's alternative investments, private credit and private equity. Private equity companies, they're buying and selling companies. And when they try to do this, a lot of times they're borrowing money to buy certain companies. So when rates spiked back up a little bit, you saw some of the private equity deals kind of dry up a little bit. Now with rates going down, you probably see some more activity and some better private equity and some better returns going forward on private equity over the last couple of years. And private credit may get affected too, even though right now private credit interest rates are pretty high, but they may come down a little bit as well. So, all these different asset classes all kind of have an impact when interest rates change. So having and knowing what this is can have a great addition to how you set up your investments.
Well, thank you for breaking each of those down too, and how interest rates are going to potentially affect all of those. I think there are some things there that I don't think people would have realized, that, a 50 basis point cut by the Fed would have impacted everything else as much as it has. All right. So you, as the financial planner, as the wise sage at Heller Wealth Management, you have to have some sort of a strategy here. So how do you, with all of the clients that you and your team service, what sort of strategies are you using to help really be adaptive or even reactive or proactive when it comes to interest rate changes?
Right. So, and you have to be careful not to try to time interest rates, because a couple of years ago, people were already saying the Fed's going to cut, the Fed's going to cut, the Fed's. Well, it probably took them 2 years before they actually cut that. So you're not going to just try to, put all your chips in one particular area. So you still want to make sure that you have a diversified portfolio. You'll have a strategy for what if scenarios along those lines, and then maybe tweak it based upon what's going on. And that's kind of what we do. So we still have, let's say on the bond side, we're still going to have bonds in the portfolio, but maybe we adjust the duration up or down. When rates are falling, we've adjusted the duration a little bit higher. When they're going higher, you want to adjust the duration a little bit lower. Again, all within your risk tolerance, all within your time horizon. But those are some of the things that we did. And we talked about the equities, how that can change. So are we rebalancing out of some of the sectors into some other sectors? And we do that on a quarterly basis, looking at that. So now do we tweak some of that based upon what we're seeing along those lines? The reserve, how much do you have in your cash portfolio? How do you do that? So those are all factors that come in play. And then we have certain kind of one-off strategies. We have a client actually call us this week, and they are putting a bid on a second home. And they actually have a second home, but they want to put this bid, buy this before they sell the other one. So then what are we going to use for the money to finance this? Well, with a little bit lower interest rates, maybe we borrow against their portfolio instead of selling some things with a capital gain rate. So all those come into play. So anytime there's a change in there, it affects everything that you're doing for your clients.
Yeah, that's a lot to keep. That's a lot to keep track. Okay, so I'm going to ask you an off-script question here very quickly. So when the Feds do change interest rates, how are you communicating all of these different things to your existing clients so that you're not just flooded with phone calls?
Yeah. So for most of our clients, it's all the clients, we've kind of educated them not only in interest rates change, but just the stock market and possibly big term corrections and also big upturns, to explain to them that we're not trying to make drastic changes based upon a short-term effect. So when the market went down, it was about a month ago, we went down 1,000 points. People were asking me, "Oh, you must have been so busy with so many calls." And believe it or not, we didn't get any phone calls. We sent out an email explaining if they want to talk to us. I think we got one email back. So we're doing the education up front and the communication up front and an ongoing basis. So when these events happen, it's really, Larry and his firm, we've already discussed that this could be happening. And I know they're going to be doing this, or looking at this, or looking at this. And when we're sending out, hey, by the way, Fed rates changed, they're already anticipated. They already know that we are already thinking about some of these changes that we're going to make in their portfolios.
Well, and before I ask you the last question here, I just want to remind the audience that what Larry is talking about here isn't the norm within financial services, which, if you know somebody who probably is panicking or excited or having strong emotional responses to what's going on, sharing this podcast with them, sharing the communication that you get as a Heller Wealth Management client is really, really important, because not a lot of advisors do this level of education. All right. So here's the last question, man. And I think this one's a mouthful. I'm interested to see where you go with this, which is, how do you balance this level of risk and return with this kind of ever-changing interest rate environment?
I don't sleep, man. That's the way I do. So yeah, I mean, that's what we do. I mean, that's what we're made of. I've got 30 years of experience. I've seen the ups and I've seen the downs. My staff has too. So we've been through this before. So we have that experience to kind of do that, to manage expectations, to manage what's going on, to not get caught up in a dramatic change based upon a short-term movement, whether it's interest rate, a stock market rally, a stock market major correction, to be prepared for everything and to manage what the clients are doing. Do they need money? Are they going to look to buy a house in a year or 2 years? Are they going to retire in a year? Or, they have a big wedding that they want to do, versus, well, this money is really for long term, and part of it's got to provide me the income that I need, and not just the income I need, because we told interest rates can change, but how can I get the net rate of return after taxes to meet my retirement needs? So yes, so we have a great staff. We work with a select group of clients to make sure that we stay on top of this, and we're meeting both of their planning needs and their investment needs. That's why the name of the firm is Wealth Management.
Yeah. All right, Larry, if somebody wants to know more about who you are, what you do, if they haven't subscribed yet to the show, please make sure that you do. But where should they go?
Sure. Go right onto our website, hellowealthmanagement.com, and you can click and schedule a 20-minute call with myself or one of our certified financial planners, or feel free to call the office at 631-248-3600.
All right. For all of you that are listening, there is so much going on in the world today that you need to have a professional who truly understands how what's going on in the world is going to affect you and your long-term investments and what retirement is going to look like. If your financial services professional isn't educating you, and if your financial services professional isn't talking about the things that we just shared today about interest rates and investments, well, they should be. And you should go ahead and reach out to Heller Wealth Management to find out how they can truly help you. So for Larry, this is Matt Halloran, and we'll see you on the other side of the mic very soon.